You know what nobody's talking about? While everyone's been obsessing over gold hitting new highs, something absolutely extraordinary just happened in the silver market. And I'm not exaggerating when I say this could be the signal we've been waiting for. Let me paint you a picture. Right now, as I'm recording this, silver is trading around $30 per ounce. Seems normal, right? But here's what's not normal. We just witnessed the fifth consecutive year of a global silver supply deficit. Fifth year in a row. Think about that for a second. 5 straight years where the world has consumed more silver than it's produced. Now you might be thinking, okay, supply deficit, so what? But here's where it gets interesting. This isn't just any supply deficit. We're talking about a structural shortage that's accelerating. Industrial demand alone is consuming silver faster than miners can pull it out of the ground. And unlike gold, which mostly sits in vaults looking pretty, silver gets used up. It gets consumed in solar panels, electronics, medical devices, electric vehicles. Once it's used, it's gone. Let me show you something that should make your jaw drop. Global silver mine production peaked back in 2016 at around 900 million ounces. Since then, it's been declining. Meanwhile, industrial demand has exploded. Solar panel manufacturing alone is projected to consume over 200 million ounces annually. Electric vehicles? Each one uses about an ounce of silver. With EV production ramping up globally, you do the math. But here's the hidden event I'm talking about. And this is where it gets really interesting. In the past 6 months, something unprecedented happened in the silver futures market. The commercial short position, held primarily by the big banks, dropped to its lowest level in over a decade. Now, if you don't follow the COMEX, let me explain why this matters. For years, these commercial traders, the big institutions, they've been the ones keeping a lid on silver prices. They'd short the market, suppress rallies, keep prices contained. It's been the pattern for decades. But suddenly, they're backing off. They're covering shorts. They're going long. These are the same institutions that have access to information you and I will never see. They know what's coming down the pipeline. They understand the supply situation better than anyone, and they're positioning themselves for a massive move higher. Think about what that means. The very players who've been suppressing silver prices are now betting on them going up. That's not just a signal. That's a screaming alarm bell. Now let me take you back in history for a moment, because what's happening right now rhymes with something we've seen before. In 1979, silver was trading around $6 an ounce. Within a year, it hit $50. That's more than an 8x move. What caused it? A combination of inflation fears, supply concerns, and massive institutional buying. Sound familiar? But here's what's different this time. Back then, silver was primarily a monetary metal. Today, it's become absolutely critical to modern technology. You can't build solar panels without it. You can't manufacture smartphones without it. You can't produce electric vehicles without it. The industrial demand floor that exists today didn't exist back then. And here's another thing that keeps me up at night. The above-ground silver inventory, the stuff that's actually available for investment and industrial use, it's at multi-decade lows. The Silver Institute estimates there's only about 2 billion ounces of above-ground silver in investable form. Compare that to gold, where there's roughly 6 billion ounces sitting in vaults and jewelry. Silver's total above-ground supply is a fraction of gold's, yet it's trading at a gold-to-silver ratio of over 80 to 1. Let me put that in perspective. Historically, that ratio has averaged around 60 to 1. During periods of monetary stress, it's collapsed to 30 to 1 or even lower. If silver just reverted to its historical average ratio with gold at current prices, we'd be looking at silver north of $45 per ounce. If it went to the lows we saw during previous crises, we're talking $80, $90, potentially $100 per ounce. But let's talk about what's really driving this. Because it's not just about ratios and historical patterns. It's about fundamental shifts happening right now in the global economy. China just announced they're accelerating their solar panel production targets. They're planning to install enough solar capacity to power entire nations. Each gigawatt of solar capacity requires roughly 30 tons of silver. Do the math on their expansion plans, and you're looking at hundreds of millions of ounces of additional demand over the next few years. Then there's the electric vehicle revolution. Every major automaker has committed to electrification. Each EV uses significantly more silver than a traditional car. We're not talking about a marginal increase in demand. We're talking about a structural shift that's going to consume silver at rates we've never seen before. And here's something most people don't realize. Silver mining isn't like flipping a switch. You can't just decide to produce more silver because prices are going up. Most silver comes as a byproduct of other mining operations, primarily copper, lead, and zinc. So even if silver prices double, you're not going to see a massive increase in supply. The supply response is limited by the economics of these other metals. Now, I want to talk about something that's relevant if you're thinking about your retirement security, because what we're seeing in the silver market isn't happening in isolation. It's part of a broader shift in how people are thinking about wealth preservation. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical precious metals into your retirement account without triggering tax penalties. Worth checking out if that's relevant to your situation. Anyway, back to what's happening in the silver market. Central banks around the world have been on a gold buying spree. They've been accumulating at record levels. But here's what's interesting. While they're buying gold for their reserves, the smart money is starting to look at silver. Why? Because silver offers something gold doesn't. Massive upside potential with industrial demand backing it up. Let me tell you about what happened during the last major silver squeeze. Back in 2011, silver went from $18 to nearly $50 in less than a year. What drove it? A combination of investment demand and concerns about supply. But here's the thing. The supply situation today is far more precarious than it was back then. The deficit is larger, the industrial demand is stronger, and the investment interest is just starting to wake up. I've been watching the ETF flows and something fascinating is happening. Silver ETFs have been seeing steady inflows, not massive yet, but consistent. It's like watching a pot of water slowly coming to a boil. The institutions are accumulating quietly. They're not making headlines. They're not causing a frenzy. They're just steadily building positions. And then there's the retail side. Coin dealers are reporting something they haven't seen in years. Premiums on physical silver coins and bars have been elevated for months. In some cases, you're paying $5 to $8 over spot price just to get your hands on physical metal. That's not normal. That's a sign of tight physical supply, even while paper prices remain relatively subdued. Think about what that means. The paper market, the futures and derivatives, they're saying silver is worth $30. But the physical market, where real metal changes hands, is saying it's worth significantly more. That disconnect doesn't last forever. Eventually, the paper price has to catch up to physical reality. Now let me show you something that really drives this home. The total value of all the silver ever mined and still in existence is roughly $60 billion. That's it. For comparison, that's less than the market cap of many individual tech companies. Apple could buy all the world's silver with pocket change. The entire silver market is tiny compared to global financial markets. What happens when even a small percentage of global investment capital decides silver is undervalued? What happens when pension funds, sovereign wealth funds, or even just a fraction of retail investors decide they want exposure to silver? The market is so small that even modest inflows create massive price moves. I want to take you through a scenario. Let's say silver goes to $50 per ounce. That's not even matching its inflation-adjusted high from 1980, which would be over $150 in today's dollars. At $50, we're still talking about a relatively modest move compared to historical precedent. But here's what that means for the market. At $50 silver, the entire above-ground investable supply would be worth about $100 billion, still tiny in the grand scheme of global finance. But for individual investors who positioned early, that's a 67% gain from current levels. And if we're talking about $75 or $100 silver, which multiple analysts are now projecting as realistic targets, you're looking at life-changing returns. But let's talk about the risks, because I'm not here to just pump silver. There are real considerations you need to understand. First, silver is volatile. I mean really volatile. It can swing 5% in a day. It can drop 20% in a week during market panics. If you can't handle that volatility, if you're going to panic sell during dips, then silver might not be for you. This is not a trade for the faint of heart. Second, timing matters. We could see a pullback before the major move higher. Markets don't go straight up. There will be shakeouts. There will be moments where it looks like the thesis is broken. That's when weak hands get flushed out, and strong hands accumulate more. Third, the paper market can stay irrational longer than you might expect. Just because the fundamentals point to higher prices doesn't mean it happens tomorrow. The big institutions can manipulate prices in the short term. They have deep pockets and sophisticated strategies. But here's the thing about fundamentals. They always win eventually. Physics always beats psychology in the end. Now, let me tell you what I'm watching for, because there are specific signals that will tell us when this move is really starting. First, I'm watching the gold to silver ratio. When that starts breaking down below 75, below 70, that's when you know silver is starting to outperform. That's when the momentum shifts. Second, I'm watching ETF inflows. When we start seeing massive daily inflows into silver ETFs, when we see hundreds of millions of dollars pouring in week after week, that's your confirmation that institutional money is piling in. Third, I'm watching the mining stocks. Silver miners are leveraged plays on the metal price. When silver moves, mining stocks typically move 2 times or 3 times as much. If you start seeing silver mining stocks breaking out to new highs, that's often a leading indicator for the metal itself. Fourth, and this is crucial, I'm watching the physical market. If premiums on physical silver start spiking even higher, if delivery delays start extending, if we start hearing about shortages at major dealers, that's when you know the paper market is about to lose control. Let me paint you a picture of what a real silver squeeze looks like, because we've seen this movie before, and it could be about to play again. Imagine this. Silver breaks above $35. That's the first psychological barrier. Suddenly, everyone who's been sitting on the sidelines starts paying attention. CNBC starts running segments on silver. Financial advisors start getting calls from clients asking if they should buy. That initial wave of interest pushes prices to $40. At $40, the mining stocks are going ballistic. Companies that were barely profitable at 25 silver are now printing money. Their stock prices double, triple. That attracts more attention to the sector. More money flows in. Then silver breaks $50. Now we're at the old high from 2011. The media goes into overdrive. Everyone remembers what happened last time. FOMO kicks in. Retail investors who've never bought an ounce of silver in their lives are suddenly trying to figure out how to get exposure. ETFs see record inflows. Coin dealers can't keep up with demand. At this point, the short squeeze really kicks in. Remember those commercial shorts I mentioned earlier? The ones who've been covering? Well, there are still plenty of speculators who've been betting against silver. As prices rise, they're forced to cover. That buying pressure pushes prices even higher. It becomes a self-reinforcing cycle. Before you know it, silver is at $75, $80, $90, and suddenly, $100 silver doesn't seem crazy anymore. It seems inevitable. Now, I'm not saying this happens overnight. This could play out over months or even a couple of years. But the setup is there. The fundamentals are there. The technical patterns are forming. The institutional positioning is shifting. Here's what really gets me excited about this opportunity. Unlike a lot of speculative plays, silver has real utility. It's not just a bet on sentiment or momentum. It's backed by genuine industrial demand that's growing every year. Even if the investment thesis doesn't play out exactly as expected, you've got that industrial demand floor supporting prices. Think about solar energy for a moment. The world is committed to transitioning away from fossil fuels. That's not a maybe. That's happening. And solar is the fastest growing renewable energy source. Every solar panel requires silver. As solar deployment accelerates, silver demand accelerates with it. That's not speculation, that's physics. Or think about electric vehicles. Governments around the world are mandating the phase-out of internal combustion engines. California, the UK, the EU, they've all set deadlines. Whether you agree with those policies or not, they're happening. And every EV that rolls off the production line consumes silver. That demand is locked in for decades to come. Then there's 5G infrastructure. The rollout of 5G networks requires massive amounts of silver. Each 5G base station uses significantly more silver than previous generation equipment. As telecom companies build out these networks globally, that's another source of structural demand growth. And here's something most people don't think about. Medical applications. Silver has antimicrobial properties. It's used in wound dressings, medical devices, hospital equipment. As healthcare spending grows globally, as populations age, medical demand for silver grows with it. All of these demand sources are secular trends. They're not cyclical. They're not dependent on economic growth or consumer sentiment. They're structural shifts in how the world operates, and they all require silver. Now contrast that with supply. Silver mine production is declining. The easy deposits have been found and mined. New discoveries are rare. The ore grades are getting lower, meaning you have to process more rock to get the same amount of silver. Production costs are rising. And remember, most silver comes as a byproduct, so supply is constrained by the economics of other metals. This is what we call a supply-demand imbalance. And in commodities markets, those imbalances get resolved through price. The only way to balance this market is for prices to rise high enough to either stimulate new supply or destroy demand. Given the critical nature of silver in modern technology, demand destruction isn't really an option. So prices have to rise. Let me tell you about something that happened recently that really crystallized this for me. I was talking to a friend who works in solar panel manufacturing. He told me they're having trouble securing long-term silver supply contracts. The mining companies don't want to lock in prices because they think silver is going higher. The manufacturers need the silver, but they're having to pay up to secure supply. That's happening right now, behind the scenes, in the industrial market. While everyone's focused on investment demand and ETF flows, the real action is in the physical industrial market where companies are scrambling to secure the silver they need for production. And here's the kicker. Most of that industrial demand is price inelastic, meaning even if silver doubles in price, manufacturers will still buy it because they have no choice. They can't make solar panels without silver. They can't make smartphones without silver. The amount of silver in each product is small enough that even a doubling of silver prices doesn't significantly impact the final product cost. Think about that. You've got demand that doesn't care about price, and supply that can't respond quickly to price signals. That's a recipe for explosive price moves. Now, I want to address something that skeptics always bring up. They say, but silver has been a terrible investment for years. It peaked in 2011 and went nowhere for a decade. Why should this time be different? Fair question. Let me answer it. First, that decade-long consolidation has built an enormous base. In technical analysis terms, the longer a base, the bigger the eventual breakout. Silver has been coiling like a spring for years. All that energy is about to release. Second, the macro environment is completely different now than it was in 2011. Back then, we were coming out of the financial crisis. Central banks were just starting quantitative easing. The debt levels, while high, were nothing compared to today. The monetary expansion we've seen since then is unprecedented in human history. Third, the supply-demand dynamics are far more favorable now. The deficit is larger. The industrial demand is stronger. The above-ground inventories are lower. Every fundamental metric points to a tighter market today than in 2011. Fourth, and this is crucial, the investment community is just starting to wake up to silver. In 2011, silver was already in a bubble. Everyone knew about it. Retail investors were piling in at the top. Today, most people aren't even thinking about silver. It's not on their radar. That means we're early in this cycle, not late. Let me share some specific price targets that analysts are throwing around, because I think it's important to understand the range of possibilities here. On the conservative end, you've got analysts calling for $45 to $50 silver. That's based on a simple reversion to historical gold to silver ratios and modest industrial demand growth. That's the base case scenario. In the middle, you've got targets of $60 to $75. That's assuming the supply deficit continues, industrial demand accelerates as expected, and we see moderate investment inflows. That's the probable scenario if current trends continue. On the aggressive end, you've got targets of $90 to $100 or even higher. That's assuming a real supply squeeze develops, investment demand surges, and we see a genuine shortage in the physical market. That's the scenario if everything breaks right. Now, which scenario plays out? Nobody knows for sure. But here's what I can tell you. The risk-reward is heavily skewed to the upside. Even in the conservative scenario, you're looking at 50% gains from current levels. In the aggressive scenario, you're looking at 3 times or more. Compare that to the downside. What's the worst case? Maybe silver drops to $25? That's less than 20% downside. So you've got asymmetric risk-reward, limited downside, massive upside. That's the kind of setup professional traders dream about. But here's what you need to understand about timing, because I don't want you to buy silver today and then panic if it drops 10% next week. Markets don't move in straight lines. There will be pullbacks. There will be shakeouts. The path from $30 to $100 silver, if we get there, won't be smooth. It'll be volatile, scary at times, and it'll test your conviction. That's why you need to think about position sizing. Don't bet the farm on silver. Don't put money in that you'll need in the next year. This is a strategic position, not a short-term trade. You need to be able to hold through the volatility. And here's something else to consider. How you get exposure matters. You can buy physical silver coins and bars. You can buy silver ETFs. You can buy mining stocks. Each has pros and cons. Physical silver gives you direct ownership, no counterparty risk, but you have to store it, insure it, and you'll pay premiums when you buy and sell. ETFs give you easy exposure and liquidity, but you don't own the physical metal. You own shares in a fund that owns metal. There's counterparty risk there. Mining stocks give you leverage to the silver price, but they come with company-specific risks. Management matters. Production costs matter. It's not pure silver exposure. My personal view? A combination makes sense. Some physical for insurance, some ETFs for liquidity, Some miners for leverage. Diversify your silver exposure, just like you diversify any investment. Now, let me bring this all together, because I want you to understand the big picture here. We're at a unique moment in the silver market. You've got a structural supply deficit that's accelerating. You've got industrial demand that's growing exponentially. You've got investment demand that's just starting to wake up. You've got commercial traders who've been suppressing prices now positioning for a move higher. You've got a gold to silver ratio that's historically elevated. And you've got a macro environment of monetary expansion and inflation concerns that favors hard assets. All of these factors are converging at the same time. That doesn't happen often. When it does, it creates opportunities that can be truly life-changing for those who position early. But here's the thing. Opportunities like this don't last forever. Once the move really gets going, once silver breaks out and everyone's talking about it, the easy money will have been made. The time to position is when nobody cares, when the fundamentals are screaming, but the price action is boring. That's where we are right now. The fundamentals are absolutely screaming. The setup is there, but the price action has been relatively quiet. Most investors aren't paying attention. That's your window. I'm not telling you to rush out and buy silver tomorrow. I'm not giving you financial advice. What I'm telling you is to do your own research. Look at the data. Study the supply-demand dynamics. Understand the industrial trends. Look at the positioning of commercial traders. Form your own conclusions. But if you do that research, if you really dig into the fundamentals, I think you'll come to the same conclusion I have. Something big is brewing in the silver market. The hidden event I talked about at the beginning. That shift in commercial positioning, that's just one piece of a much larger puzzle. And when you put all the pieces together, the picture that emerges is one of a market that's setting up for a massive move higher. The question isn't whether silver will go to $100. The question is when, and whether you'll be positioned to benefit when it does. Because make no mistake, this move is coming. The fundamentals guarantee it. The only question is timing. And here's the beautiful thing about silver. Even if I'm wrong about the timing, even if this takes longer to play out than expected, you're holding an asset with genuine utility and value. You're not holding some speculative cryptocurrency or meme stock. You're holding a metal that's been valued for thousands of years and is more critical to modern technology than ever before. That's the kind of asymmetric bet I like to make. Limited downside, massive upside, backed by fundamentals that are undeniable. That's what silver offers right now. So pay attention to what's happening in this market. Watch those signals I mentioned. Watch the gold to silver ratio. Watch the ETF flows. Watch the mining stocks. Watch the physical premiums. Because when this move really gets going, it's going to be fast and furious. And you want to be positioned before the crowd figures it out. The data is there. The setup is there. The hidden event has already happened. Now it's just a matter of time before the market catches up to reality. And when it does, $100 silver won't seem crazy at all. It'll seem inevitable.